Hi, this is Professor Rujo Moreno with a review of Chapter 1. We're going to do Learning Objective 1 today. So let's take a look at the first objective, which is to give you an understanding really of what managerial accounting is about compared to both financial accounting and how managerial accounting helps the management of the company make better decisions. So first of all, a lot of you are coming right from the financial accounting class, which is really, really good because you're going to see some really big differences right off the top. First of all, it's really important to understand that both financial accounting and managerial accounting are very, very important aspects of an organization. Managerial accounting is a little bit more detailed because you need to determine, say, the cost of something. Before then, you can report it, which is what financial accounting does. There's more of a reporting side on that rather than a determining side for costs. Both are extremely important. They're both needed, but there are some really big differences. Managerial accounting, of course, their most important function is to provide economic and financial information to the managers. And the purpose of that, of course, is to make sure that better decision-making is happening. Managers are ultimately responsible for the profitability of the company. They're the ones who are going to be held responsible for that. So the better information they get, the better decisions they can have, the more efficient the operation can run, and the more profitable it can be. Let's take a look at this illustration, which shows you some differences between financial and managerial. First, when it comes to the primary users of the reports, in financial accounting, everything we were doing in Accounting 104 in preparing, say, an income statement or a balance sheet was really meant for folks outside of the company to see. Remember, we were looking at public corporations and their requirements to report. So they're reporting out to the government, say the SEC. They're reporting out to investors. They're also reporting out to potential investors. They're reporting out to the public in general, which could include labor unions, creditors, other types of things that could be looking at this information. So financial accounting reports out for really external users. Managerial accounting is simply for management eyes only. So everything that managerial accounting is doing is at the request of the management of the company because they need information to make decisions. This is not something that goes outside of the company. The types and frequency of reports are different as well. In financial accounting, we had to do quarterly reports. That was required. We also had to do an annual report. We've talked about that. Those work like they're clockwork. Every corporation needs to do that on a regular basis. For managerial accounting, there's no particular frequency that's required. It's just whenever management needs to know something in order to make a decision, reports are needed. So as frequently as possible or as less frequently, it depends on what's going on. There's no specific time frame in that regard. The purpose of the reports are also very different. Financial accounting provides general information. Managerial accounting really provides very specific information on a specific question management is dealing with, whether to go ahead and make additional products on the assembly line, whether to invest in a new piece of equipment or refurbish the one they already have. These are very specific instances, and those particular reports are addressing those specific ones. That's much different than what you had in financial. In terms of the content of the reports, well, again, anything in a financial accounting report has to go by the rules that we called GAAP, generally accepted accounting principles. Those were the guidelines that set up how we process information and report out information. Those reports are really about the business as a whole, and they're often include everything under one roof. So that's the aggregate part. For managerial accounting, it's very different, right? Because in managerial accounting, it might be that there's something going on in the production department, but it's very specific to that department. It might be very important. So the report could be specifically about what's happening in one particular area. These reports tend to be extremely detailed because managerial accountants are diving into as much detail as possible so managers can understand what's going on. And basically speaking, unlike financial accounting, which is guided by GAAP, there are no such external types of processes involved for managerial accounting reports. They are for management eyes only. And so they're less stringent in that regard. They're not governed by GAAP. The verification process is different as well for financial accounting. The paper trail is there. These are being done inside a company by folks who are financial accountants or CPAs. They are required to have their work checked by an outside CPA. That's the auditor. So an outside CPA firm will check the work of the inside CPAs. Because all the rules are the same, they can determine whether things are going according to GAAP. In managerial accounting, there's no such thing as an independent report because this is strictly for management eyes only. So no one else is really going to be seeing these reports. Managerial accounting is about helping management. And you've all probably taken some type of management course, whether it's a foundations of business course to see the management functions, or you might have actually gone through business organization and management already. But nonetheless, there are many different management functions. They are been encapsulated into a few here: the planning function, the directing function, and the controlling function. So very specifically, the planning function requires managers to sort of look ahead and make a plan. These plans involve what we're going to be selling this year, how much we need to make in order to sell that, what are costs of making all that stuff, what are the expected profitabilities in that. So it's all about the planning events, and they use, as we'll look deeper in the course as we get way at the end, on how they use budgets to plan those types of things as well. Then there's the directing. Okay. So directing involves coordinating the company's activities to make sure the plan is working, right? It basically makes sure they're implementing the plans as best that they can, making sure everyone's on top of things, everyone's informed, there's incentives and motivation in place, etc. So directing is basically doing the plan, right? And of course, as you're doing the plan and you're implementing everything, you need to make sure that it's going according to plan. And that's really what the controlling function is all about, making sure the company is keeping things on track, right? And if they're off track, which oftentimes they can go off track because plans are plans and reality is different, the control function requires managers to go ahead and kind of tweak those plans to see if they can catch up or do something different to make sure that they're running smoothly. And all of these functions require data that management accountants help put together and feed to management. The economic and financial data they're giving to management is to help them make better decisions and to help them manage better. All organizations, as you know, have structures. Organizational charts vary from structure to structure. This is for a corporation. You see at the very top, you have the stockholders, which are the owners. And then at the very bottom, from the box that says CEO and president all the way down, that's the bottom part of that box. That's the top management of the company. Notice that in a corporate form, the owners are not the managers. The owners are represented by that little box in the middle called a board of directors. They are elected to represent the stockholders' interests. The stockholders' interest, of course, is to maximize their investment, maximize the profits. And it's that board of directors that goes ahead and hires the CEO and president and the upper management team to get that job done. So it's really important that you sort of understand a little bit of this particular structure, that it's very, very different than in a corporation than it is in other organizations like a sole proprietorship, partnership, or others. And this is the end of learning objective 1. There are a few questions here that at the end of every learning objective, there's a little do it exercise that's good to review. In this case, the do it exercise is pretty simple, about true or false statements for your introduction.